What's up, world? This is Sophisticated Investing Life, and today we're going to discuss why the media is overblowing Robinhood's trading practices. So before we get started, make sure to tap that like button, especially if you're a Robinhood user, as well as subscribe to the channel to learn more interesting ideas about becoming a sophisticated investor, taking your investing game to the next level. Now, we all know about Robinhood. It's an investing app that allows users to trade stocks, options, even cryptocurrencies, all with no trading commissions. This sounds really good, and it is pretty good. The company started around 2013. Now it's grown to over 6 million users on that platform last time I checked. And now FINRA is trying to show up and shut down the party. Now, what happened? Right? Earlier this week, FINRA, a major regulator in the financial industry, fined Robinhood actually $1.25 million for not allowing the best trading execution practices during 2016-2017. What this means is Robinhood didn't go out of their way to get the best trades for the customers, for their clients. Instead, they decided to sell, well, not sell, but let other brokers that maybe didn't offer the best price, but Robinhood was very comfortable going to. They went to those brokers all the time. Why did they go to these brokers all the time? It was four in particular, and the reason they kept going to them is because they were paying higher prices to see those trades. Now, why is that a problem? What's the big concern here? Those four market makers paid top dollar because they wanted to trade against the order flow, collecting small spreads along the way. This is how high frequency traders make money. Essentially, they're collecting pennies here or there over thousands, if not millions of trades. And that profit builds up over time and it actually turns into something substantial. Now, the headline firm that was involved with that is a hedge fund named Citadel. Citadel is about $30 billion. Yes, with a B. Lots of money that somehow still beats the market over time and is ran by a billionaire investor named Ken Griffin. Very intense dude, by the way. Like, look into his eyes, he's a very intense dude. Now, Citadel was willing to pay top dollar because they actually have some high frequency traders within that hedge fund platform that maybe could use that information to, use the retail trades and just do a little bit of maneuvering around those trades to help get their profits up. Now, this sounds bad in theory. This sounds horrible in theory if you kind of think about it. This is like the trade-off, right, for free commissions. But in reality, it's not that big of a deal at all. Why, you may ask? It's because that spread, like I mentioned before, it's a couple of pennies. It's only a couple of pennies. So take, for example, right now, Uber stock, right, trading around $31. Now, the difference between $31.10 versus like $31.02 if the stock is trading around 31. That's what we're talking about. We're literally talking about 8 cents here in this particular for this particular stock, or maybe a stock like Amazon that's worth thousands of dollars. It's maybe $1 or $2. Now, actually, speaking of Uber stock, sidetrack, check out my video about the bull and bear case for Uber, what a hedge fund manager thinks, and what a famous YouTuber thinks. Check that out in the card above. Now, like I was saying before, these little pennies or maybe $1 or $2 differences sounds bad in theory, but they're not, because if you're on Robinhood, you're not supposed to be day trading, maybe not even supposed to be swing trading. You're supposed to be a longer term investor. And when you're investing for the longer term, $1 here or there does not matter. A $30 stock like Uber, you're investing hoping it gets to $60, $70, $80, $100. So $1 here or there is not going to really affect your returns. This is also why Robinhood doesn't allow for penny stocks to be on their platform. It's not even on their platform because they know that they can't execute at the best price, especially the setup. Robinhood is similar to a lot of these other online platforms that offer free trading like M1 Finance. They execute all trades maybe at the beginning of the day, trading day, or at the end. And in doing so, that allows them to just get everything out at once. Now, will you miss out on a percent here or there? Yeah, but what's 1 or 2% when you're looking to get 50 or 100% on a stock, right? So it really doesn't matter as much as you may think. And to be honest, it doesn't really matter to FINRA anyway, because A, that was in the past. Robinhood doesn't do that anymore. And B, they find a company that's worth $7 billion, only 1.25 million. Like that's less than a slap on the hand. Like that's less than a slap on the wrist. It doesn't mean anything. So the media might be taking it too far. There's one person, like a financial blogger in particular, is talking about, of course, Robinhood's taking from the poor and giving it to the rich, like Ken Griffin. They're blowing it out of proportion. It is not that big of a deal at all. So just keep that in mind. I'm not a Robinhood user myself, but I do see the value in Robinhood offering those free trades, and I would be willing to make that trade-off myself if I was in that predicament. So for those Robinhood users, again, make sure to tap that like button and subscribe to the channel, and let me know your thoughts in the comment section below. Is this a big deal to you all? Did you even know this was a fine? Just let me know in the comment section. Oh, for those interested, if you really want to learn how to take your sophisticated investing to the next level, make sure to go into the description and download my free PDF discussing Warren Buffett and his top 3 secrets on building wealth. Trust me, you'll need to read that if you haven't read it before. So that's all I have for you all today. So until the next time, thank you for watching and stay sophisticated.